Welcome back, everyone, to May 26th for our Global Economic Outlook that we do weekly every Tuesday at noon. Thank you, everyone, for joining us, and we'll get going. As usual, my name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And thank you for joining me every week. We've had a great response and great follow-on to these weekly updates, especially on the replays. I know those who like to watch it at their convenience. As always, it is available online that you can forward or rewatch or watch at your leisure when time permits, as we're all getting busier and busier as quarantine slowly starts to ease here. Just to cover off things as usual, the information in here is for viewing purposes only. Do not take it as advice. Everyone's situation is unique, and you should always contact us for a personalized review of your situation and see how the information in here can be applied to your situation. And as always, the information we do send out through these videos is as accurate and up to date as we possibly can get it. But it's constantly in a state of flux and change. So always do your own due diligence, or just reach out and we'll happily answer any of your questions or give you the most accurate information and up-to-date information we can get. You are all, everyone viewing here live, you are all muted and your videos are off. But if you would like to ask a question, you should have that Q&A icon there on your screen. If you don't see it, just shake your mouse a bit. It should show up and you can type a question, and we'll try to get to it, time permitting. We are trying to keep these on a fairly compact timeline, just to make sure everyone has time to get through them. And just as a reminder, we have shortened these up a little bit to focus just on what we've seen in the last week and what we're seeing coming up this week. And every Friday, we're putting out our deep dives with our Mike on Money video, which we tackle different topics. And last week, we dove into ESG investing, or environmental, socially, and governance investing, or sometimes called socially responsible, or SRI. We did a bit deeper dive into that last Friday, and we'll have a new video coming out this Friday. So let's jump into things and see what's going on in the economy. This week, what we're looking for coming up is the regional and state unemployment and employment numbers. Of course, the impact of the COVID and the quarantine has been massive on the unemployment issues all around the world, not just here in Canada. We're watching closely in the US, as that's one of the more major economies that will impact us. Also, we're looking at the earnings from Deere & Co., farming equipment manufacturers. We are at the tail end of earnings season, but it's still important to get the most up-to-date numbers that we're seeing, as more and more we're seeing how deep the impact was in the first quarter, but also what the guidance we're getting for the second quarter. As it will be a much heavier hit with having almost 2 full months of closed industries, and also the slow start up again. In the US, we're starting to hear from the government's likelihood of another stimulus package. Of course, the first stimulus package kind of shored up the economy as we dove into the shutdown, and likelihood of a second round is increasing every day, as those unemployment numbers and the slow start to the economy is going to take a little bit longer than some had originally expected and maybe even hoped. The pandemic is causing a serious threat to the Fed's goals as far as inflation goes. Of course, they want to keep inflation within a range of 1 to 3%, and also don't want to go into deflation. So the US Fed is monitoring that very closely. And a bit more challenging, of course, in 08-09, we went through a financial crisis, which gave the Fed a lot of challenges to manage that. But this one's a bit different. Even though the 08-09 was a big economic hit, we have a complete shutdown of the economy. So it's quite a bit different, a little bit harder to manage. But it is going well so far. I don't want to seem pessimistic. We are seeing some positive things come out of it. The other shift that we're seeing, Facebook and now Google and Twitter, and we'll talk about Canada in a moment, but we're seeing a shift to permanently look at remote work. So as I mentioned, Facebook, Google, Twitter have all announced that they're going to make the work from home option a permanent status for them. And that's got a lot of impact. Not only are we talking about office real estate, having excess of that if companies start downsizing, but also keep in mind the type of workers, the way that companies hire will now shift. If they're looking at a work from home type of employee, that's a very different profile. A lot more access to jobs for people with disabilities, maybe even older people with more experience than the younger. But we're seeing this bigger and bigger shift from some large tech companies. And that's starting to expand. I think we're going to see a lot more names come out with those types of announcements as we go along. Beijing has scrapped their GDP target this week. That's quite a big piece of news because what we're looking at, China is they went into the shutdown earlier. They've come out of it earlier than everybody else. So that's shown us that the rebound in the economy after reopening has taken longer than they expected. So they're no longer giving guidance as to what they expect for 2020, which not only makes it a little harder to predict where we're going, but it is a sign saying that it's not recovering as quickly as they hope, that they're not seeing strong numbers, especially in the areas that were most heavily affected. Bank of Japan unveiled new funds for their banks, keeping their banks liquid. That's part of their stimulus package, so that continues over there as well. And the coronavirus infections jumped more than 1 million in less than 2 weeks. So one of the largest jumps we've seen so far. And I'll dive a little bit deeper into the total numbers that we're seeing globally momentarily. What else do we see? So here's not an overly surprised one, but we're starting to see the movement happen. Is the unions are making it easier for workers at Amazon to protest as they look for better working conditions, better benefit packages, better pay. We're probably going to see this across the board for those that were deemed essential workers through this crisis. It's very hard, I think, for society to go out and say these are essential workers and, of course, pay them the least. So we're definitely, this is just the beginning of probably a lot of new contract demands, a lot of new pay demands. We're seeing in Canada, of course, Trudeau coming out yesterday in support of a mandatory sick day program for employers. We're going to see a lot more of that. We're going to see a lot when the healthcare workers going for their contract negotiations. Of course, they've been on the front lines. The other thing to keep in mind behind this movement, if you look at the population as a demographic, there are far more what we deem as millennials out there than there are even baby boomers. The baby boomers had more kids per couple, but there was more couples having kids. So the millennials is actually a much larger generation as far as numbers. And we're going to see this power, just like we saw the baby boomers move through the economy in the different stages of their lives, what they were looking for from either governments, so from a voting perspective, but also demand on businesses and economies as they move through. And they're at that stage where, you know, they want support. They're starting out, they want more benefits. They want things from their companies more so than, of course, when we get later in life and we've made a lot more of our, grown our career, our income, our savings, our means are higher. We want things like less taxes. So we do have this shift in demographics happening, moving through the economy. And this shutdown may have hit a little bit of a speed up button as to how much impact that younger generation is going to have on our recovery, as they're in the biggest need right now because they were very likely the hardest hit by the unemployment numbers. So something to keep in mind as we see this come through. In the US, we've seen a little bit of slide in the economy. Car manufacturers, we mentioned last week, went back to work, reopened. Uh, and one of the early signals we've seen right out of the gate is we're seeing reports out of the southern US of trucks being one of the most popular being purchased. Some of the dealers in the US reporting the Dodge Ram, selling record numbers for a month, around 2,700 new just in Iowa. And then of course we saw Trump visiting the Ford plant as well. Not surprising around the truck demand. That actually is something we've seen many times. Very often we see that when fuel prices go down. Of course, cheaper gas, bigger vehicles, more expensive gas, smaller vehicles. So it is a trend, and with oil prices still low and the price of the pump cheaper, people are going for the larger vehicles as they see deals out there after the reopening. The junk bond market is starting to sour a bit. And this was, in the early stages when we talked about this in some of our previous videos. In the early stages of this pandemic, we saw some companies that needed cash to get through it, so they went out and financed. We talked about the lines of credits that were being maxed out for the corporations. Some of them went into the bond market. Part of the U.S. And Canadian stimulus package was to guarantee liquidity on those. So that meant that they were able to raise the capital. But now, as we move deeper into it and seeing a bit more impact on the companies, of course, the pricing on those bonds are starting to decrease a bit as more and more risk builds around a potential failure on those senior debts of the corporation. So, not a surprise. There may be some good buying opportunities in the debt area as companies come out of it. As we get a little more insight into the second quarter impact. But definitely an area, if you're not aware, the bond market tends to telegraph the stock market ahead of movement in the stock market. So it's an area we'll definitely keep a very close eye on. Other headlines we've seen, COVID surcharges. So we might have seen this in the news. We're starting to see it pop up in restaurants, some retailers. Things like personal care, hair salons, passing on the cost to consumers who, for all the extra cautions that have to be taken, whether it's supplies, face masks, plexiglass, or extra measures that they have to put in place, or even just the fact that they can't open to full capacity. So, they're working full hours, they're paying employees for full hours, but they're not able to process as many customers. And we're starting to see this COVID surcharge take hold in a lot of areas. So it'll be really interesting to see how broad-based that gets and how long it lasts. Of course, it's going to depend on the reopening schedule, and that is completely in the state of flux. Even here in Canada, we saw Ontario start to do the reopen on the weekend. They had some problems with a few of the beaches. And Premier Ford has dialed back the schedule on the reopening schedule, just because some people went a little bit too far, for their comfort. So how long this could last, we're not sure. We'll have to keep an eye on the rollouts. The job market, we've seen a slower decline. So this is just saying that the number of jobs lost has started to decline. We are still losing jobs, so it is not improved at all so far in May, but it is slowing versus April, which is a good sign. And we should see that start to increase here as the reopening starts to happen. More and more companies will be bringing back some workers or even hiring some new workers, depending on the availability of those previous employees. So we're probably going to see that continue to slow, maybe even go into the positives as new jobs open up again. But there's still some major employers that are not bringing them back. The airlines, for example, Air Canada, who we mentioned last week, let off 20,000 workers. That's not reversed yet, and probably not for a little while as they try to entice people back to travel. But we'll talk a little bit more about that as we talk about the economies. China's looking to tighten control over Hong Kong. So this is kind of just picking up where they left off going into the pandemic. Of course, there was many protests in Hong Kong over China's tightening of their security laws around Hong Kong, which predominantly was a democratic society after being turned over back from the UK. And that was supposed to last for 40 years. They're not there yet, but China's starting to tighten their grip as far as legal and control goes. And they've taken the opportunity of this pandemic to pretty much put through the laws that they were trying to put through going into COVID prior to those demonstrations. They're starting to accelerate their move there. And we're seeing a lot of in their Congress. We're seeing a lot of discord as the two sides, the pro-democratic side and the pro-China side, combine or conflict on those issues. So we're going to watch that really closely. China's probably going to be able to go ahead with it, and very likely accelerated, as I said, by the pandemic situation. On top of everything else we've seen in 2020, the forecast is predicting a very rough hurricane season. We're already seeing some flooding in Florida areas. The emergency systems in the U.S. are starting to prepare and get ready, get aid ready, get the utilities to think about how they're going to mobilize if some devastating storms should hit shore. So, not good news on the overall recovery front, but something we'll have to keep an eye on as these things are unpredictable. So where we are around the world, well, total cases worldwide is about 5.6 million, and total deaths almost rounding 350,000. The U.S. Is through this morning 100,000 deaths, so that was I don't know if any of these numbers are a milestone. I think they're all devastating. But as they continue and showing no sign of slowing as the U.S. reopens, that number's probably going to climb quite a bit higher. What we're really looking to, though, is economies like Spain and Italy, who are also very hard hit as they start to reopen now. Of course, we're looking at a possible second wave, or if they can manage that with social distancing, but also how the economy gets impacted from that high of a death rate. So as far as a percentage of population, they saw some of the highest numbers, and taking that many people out of the economy, how does that affect the recovery, whether it's how quickly the jobs are filled or how slow the recovery in the consumer discretionary areas like the restaurants and food haven't had that impact. So we're watching those two economies very closely because they were, some of the hardest hit when it comes to total number of population. So let's see where we're at today. What's going on in the markets? The Wall Street indexes last week fell a bit, although we saw a big plus number in the US this morning. Overall, they did see a bit of fall last week based on tensions. We're seeing some renewed tensions in the trade dispute with China. We'll dive a bit deeper into that. We also saw the crude prices gain a bit, or gain the highest since March. Now, keep in mind that's the highest since the low in March. We're also seeing a little bit of uncertainty around that, but we'll dive more into the commodities in a little bit here. And we'll talk about the currencies as well, as the US dollar rose a little bit. We did see gold slide a little bit, although rebound again. And that's just moving on sentiment. As people become a little bit more positive, gold will rise. And of course, last week with more trade concerns, we saw gold being a little volatile. Not big swings, but a little bit of movement there. We're looking at this week, the Chinese e-commerce giant Alibaba is going to report their fourth quarter numbers. So this is the first time we're going to see a much deeper impact into the coronavirus. As I mentioned, China did close down earlier than North America. So here's a large manufacturer where the supply chain was disrupted. So we're going to get a bit deeper insight into what happened over there, and also what's been happening since they started to reopen. As I mentioned, Deere & Co. is going to announce their numbers. It's going to give us, again, a bit closer look into the supply chains in North America, especially how the lockdown affected the farming and food and factory industries, and how that is impacted, and what we can forecast from that moving forward. Mexico put out their first half inflation data for May. And of course, nothing there. A little bit of pickup on the inflation side, as we're seeing some higher prices due to a limited supply. But then also the retail numbers fallen dramatically since February. And we'll probably see that run straight through to April and May, as people weren't able to get out. In the US, Macy's talking about being a much smaller company going forward. They're closing a lot of companies. First quarter, they announced losing up just above $1 billion. And remember, that was first quarter, where it was only March that they were really affected. So second quarter, very likely another hard hit for them. As we're probably going to see a lot on the retail side, especially the areas of the market that people weren't buying from. There wasn't a lot of clothes shopping. People weren't going out. In fact, the only areas we saw some spike in clothing is kind of the Lululemon, the Nike, Gillian, the leisure wear, where people started buying more and more sweatpants for staying at home. But as far as the kind of work clothes, shoes, that type of wear, all pretty much across the board, we've seen a major impact. So those numbers are probably going to be very ugly through the second quarter. Best Buy, although seeing some good numbers in their sales, they are seeing rising costs. And again, this is a trend we should look for. Not necessarily negative. It's simply showing us the impact as more and more people are ordering online. So shipping costs has to be factored in. So the company's profit margins are going to be under pressure. That's not necessarily a negative. That means the companies are adjusting to this online new reality, and the prices over time should reflect and adjust for that. And that's why we're watching inflation. But we're probably going to see that even in healthier industries like grocery stores, where they've had to pay more to their employees. They've had to do more online deliveries or local deliveries. All that adds to their costs, even the face mask and supplies that they need for the stores. So not a surprise, not a negative, but certainly something that we're seeing. As I mentioned, Trump visited a Ford plant in Michigan. We probably saw that on the news. So let's not forget, there is a U.S. election going on. So, Trump's out there trying to swing voters. Michigan is a swing state. We also saw Biden getting out this week. And so we should see more and more of that as the politicians go out and check up, I guess, on the economies and try to push their agendas with the public. Schlumberger names a new executive. Schlumberger, of course, an oil and gas company. We're likely to see this in a lot of different companies. I kind of equate it to the Churchill phenomenon. Churchill was a great leader during the war for the UK. And then after war, people, the sentiment turned as he wasn't really a peacetime leader. Companies are not much different. Different skill sets are needed during very difficult economic times. So we're probably going to see a lot of shifts in the leadership in some of the companies as they bring in someone whose specialty might be cost control, business development, whatever that particular industry or a company needs at that moment. We'll see a lot more of these shifts happening through all this, especially through the second quarter. TJX also seeing their sales start to recover after their initial slump. TJX is a department store. And they're starting to see things come back again as they reopen, which is good, that people are actually coming out. So we'll be watching companies like that very, very closely as well. On Canada, March retail sales are expected to have dropped roughly 10%, maybe even a little bit more. This is being gauged off the job losses of 226,000 or more in March. April is probably going to be worse because it was kind of the full shutdown. And then May and June, we should start to see that recover. So not necessarily negative. We want to see how bad the impact was so that we can gauge how fast it is recovering. So nothing overly negative there. Canadian banks earnings are predicted to drop about 36%. The banks have underperformed in this recovery that we've seen as they build up loan loss provisions. No, loan loss provisions are not actual losses. This is just what they're putting aside or what they're writing off as far as expectations go. That being said, Scotia did come out this morning, was slightly better than expected. Now, they did drop. It was just slightly better than that 36% drop. So we'll keep a close eye on the banks. Scotia also did confirm their dividend to remain the same, which we do expect the Canadian banks to keep their dividends the same or not cut them. They did not cut through the 08-09 crisis, and we don't see any real rationale with the government stimulus that they should cut during this crisis. On the mining side, Hudbay Minerals is putting out their earnings. We're again a trend we're going to see within an industry. The Peru copper expansion has been put on hold, slow down for 4 months. And this is just not being able to get the workers out just due to the pandemic. And they're no different than anywhere else. And we're seeing that in a lot of areas, including mining. But on the positive side, we have seen a lot more activity as far as projects on the mining front. Geologists are being moved around and hired to look at new projects. So there is some activity going on there. Shopify in Canada, also much like Facebook and Google, moving to work at home permanently type of economy. Again, this is something we're really going to look at from a lot of different angles. I mentioned the hiring angle, but also the spending angle. As I'll talk a little bit more about this in some recommendations I have, but these companies now have to equip these people at home. I've talked to a couple of execs at Dell, and the number of machines that they're sending out has quadrupled versus their average monthly purchases, and that's corporations buying up hardware for employees to work from home to be able to offer the same services that they work in the office. So I just wanted to put this out because we have seen this rally in the market, and I've talked about the concerns that we probably will see some sort of pullback here as we get more real economic numbers. Again, I do not see that as a negative. I see that as a positive. We have to work on real data. But this is just an example of some of the overexuberance we did see in March and early April. Of course, Zoom, which is the platform we're talking on today, the software company, it's that yellow line, as it's seen very positive growth through all this as more and more people have subscribed to their services. But there's another Zoom out there called Zoom Technologies, and look how much that price spiked, and people were buying the wrong one. So that's just showing you some people are acting on just superficial news. They're not doing a deep dive into really what they're buying. I've talked about that in the REIT area, which I'm looking to do a deep dive on the REIT market because there is a big spread between industrial REIT, kind of your warehouse or industrial use, manufacturing use, versus retail. And all through there you have commercial space, you have a residential and office. There's lots of different shades through there. So there is a little bit of overexuberance in the market. Some investors jumping on broad news as opposed to taking a deep dive into what they're looking at. So don't look at some things and think that was missed. As mentioned, we are looking at a bit of a pullback coming here, but also we're making sure that we're looking into the right areas of growth for you. So as far as currency goes, as I mentioned, the US dollars did strengthen slightly last week. Again, not a surprise. A flight to safety. The US is still seen as the global currency. You know, the euro traded down slightly, as well as the pound. The Canadian dollar, though, strengthened against the US a little bit. We're at 0.726, and that's a little bit on the bounce back in oil. Canada still trades a bit off the oil price, although not as much in the last couple of months, given the swings in oil. But it is showing a little bit of strength with oil coming back up. But probably we're going to see the U.S. dollar maintain strength through the summer with all the volatility. And as the economies come out of this, as they slowly start to gain their own traction without stimulus packages, that's where you see the Canadian dollar really start a bigger climb, as global investors start to divest from the U.S. dollars and go back to their domestic currencies once they see stability at home. On the commodity front, as I mentioned, oil showed some strength. It did pull back from its high. It's back up a little bit today, just shy of the 35 at my last glance this morning. The future markets were down a little bit. That's the June, July futures. So it's above above $30, which is at least a benchmark that the industry can work with. Now, that's mostly been driven on speculation that demand is going to increase, but also on the fact that supply has been cut dramatically by the OPEC countries and other cooperating countries. So it doesn't mean that we don't still have a glut of oil out there, just the tap has been turned off enough that it's been able to get a little bit of traction, which is good news, but it doesn't mean oil is out of trouble yet. Also, above 30 is a good starting point, but it's not a healthy point. So we will continue to keep a really close eye on that. You know, one of the big challenges, as I mentioned earlier, China has stopped giving forecasts. They had stopped giving you know, what to expect, and given that they're the largest importer of oil in the world, that makes even bigger challenges for the oil outlook, or for the oil companies to really you know, adjust, which makes the oil pricing very vulnerable here over the next couple of months. So we, you know, again, good news, we're above 30, but we'll keep a very close eye on the oil. It's still a fairly risky play. As I mentioned, gold, my previous slide said it slid down. This slide, which I updated as of this morning, rallied a little bit, and we are seeing that little bit of volatility. It's not moving a ton, as you know, less than 1%. But we are seeing that move as sentiment starts to get a little more optimistic. Even though the data is starting to become a little more negative, we need to see that negative to become optimistic, because we need to see a little bit of light after the dark, and that's what we're starting to get coming out of things here. So before I end things off today, just a little bit, I got a lot of requests around ideas. Now, again, not advice. I'm not saying go out and buy these companies. These are the ones we're watching really closely across all the major sectors in Canada and the US. And we are looking for the right entry points. It doesn't mean they're a great buy at any time. But on the energy front, you know, Enbridge, the pipeline, we do like that one. It has been hit very hard through the oil crisis here, just like all of them. But we feel they're really well positioned on the resource front, on the oil front. Canadian Natural Resources, a good play. I still like Suncor. I still think that they're got a great, healthy balance sheet. But as far as recovery, returns, Canadian CNQ, sorry, is well positioned. On the material front, your metals, still looking at gold. Barrick and Franco-Nevada are probably your best values. On the industrial front, Waste Connection has been in our portfolio for a while. We've really liked it. They do, of course, waste management. That has continued. Municipalities continue to pay. It's an essential service, basically. So we do see that still as a continued good value. We've added to our list there Kansas City Southern Rail. We do have CNR, Canadian National Railway, in our portfolios. Hopefully your screen didn't just go black. Mine timed out. Sorry. There we go. let me go back. The CNR, CNR, the Canadian National Railway, we do have in our portfolios. We still like that as a position. The Kansas City is just a more regional, a little bit more dynamic purchase, something to keep an eye on. On the consumer discretionary front, kind of your home shopping, Amazon still doing well, despite, the labor issues that they're definitely going to run into. Something we'll keep a very close watch on. But they still represent a good buy. And Home Depot, as people have stayed at home and done a lot of projects, we have seen a push in that. On the consumer staples, Couche-Tard again continues to be on our list. It's been in the portfolios for a while. Couche-Tard is a grocery convenience store chain, supply chain in the eastern part of Canada, represent a great value. Tractor Supply, home building, home improvements, agriculture supply companies out of the US, again, as people stay home more and the supply chain starts to reopen, we expect them to do quite well. Healthcare, Johnson & Johnson, again, been one that we've had for a while. A very diverse group. I mean, a lot of people look at them from the pharmaceuticals, but they also go into soaps, toothpaste, even foods on the distribution side. So a very broad conglomerate. Bristol Myers, same idea, just the American, they're both American, but Bristol Myers, just a slightly different, diverse product group. On the financials, S&P and MSCI, these are global. They're both global financial index news rating companies, kind of a side service into the financials, but they represent a lot of good value right now. Technology, Apple and Microsoft. Why we like those right now, or this goes back to more and more of these companies switching to work at home. The hardware has to be purchased, the software has to be purchased, and new support softwares for the already existing platforms that these companies run mainly come from these two companies. So a lot of potential sales in their pipelines as companies shift into those areas. And as always, it kind of falls between the financial and technology crack. I still really like the Visa and MasterCard play. They're considered technology companies. Although they're seen as financial, they don't own debt, remember. It's just on a usage basis, so keep that in mind. Communication, Netflix, of course, we've seen do quite well through this. But keep in mind, it's not just been the surge of people being at home watching all that Netflix, but now people have started new habits. They've engaged with those series or those offerings, and we'll see a lot more. And of course, on the Facebook front, again, more and more people have had to jump onto technology and embrace that, using those habits have changed. So we do see some benefit going forward for them. Utilities, we always like Fortis, of course, great. We've had it in the portfolios, and Nextera down in the U.S. Actually, one of the leading, based out of Florida, one of the leading green energies companies down there, electrical power. So we quite like that. And on the real estate, these are again a very side way to play real estate. They're categorized as real estate. American Towers is the cell phone towers. As we expand into 5G has a shorter range than LTE, so that requires more towers, more stations. So American Towers is one of the largest and best positioned to take advantage of that. And Equinix is a provider of data management. So both those, despite being categorized as real estate, definitely on the technology front, but on the real assets of the technology front, as opposed to just the IP side of things. So that's it for today. Let me just see what we have for some Q&A. Looks like we do. So one of the questions I have is, can I share some data on how the portfolio has compared year to date, and what are the benchmarks? Good question. Thank you. So the portfolios, yeah, they've performed very, very well. As I've mentioned in some previous videos, we went into this as far as our portfolios anywhere from 30 to 60% cash, depending on people's risk tolerances. So, and also we were away from things like consumer staples, and we focused more on the discretionary side, kind of expecting a pullback this year, looking for a recession, given everything that was going on around the world. So they performed really well. As far as performance, I'd be happy to show you some examples based on specific risk tolerances and benchmark. It's difficult because we tailor make the portfolio to the individual's risk. So we use very similar positions across different individuals because those are our best picks, but we weight them differently dependent on the risk tolerances. So not everyone gets the best performance, the same performance. The best I could give you is kind of a rough gauge. Is the portfolios at the end of April were near, I think they were 1.5% off their highs of early February, so pretty much fully recovered. I think they dipped the lowest on average in March. The lowest they got was about minus, I think our most aggressive was about -7, and our more conservative is about -4. So that, versus the benchmark got to almost -30, the index got to almost -30. Benchmark is really tailor-made to the individual. So I can give you more specifics if you want to call in or email us with your specific situation. I can give you a benchmark and how we compare to that particular benchmark. But as a broad stroke, we definitely outperform the markets to the downside. As to the upside, we're outperforming because we didn't go down as far, but we haven't got the full capture yet because we haven't deployed all that cash. Like I said, we're definitely looking at another pullback here as we go into the summer, and that's where we're going to deploy that cash and take advantage of it. Now, one thing I will add as a follow-up to that, there is a lot of talk about how long it's going to take for the economy to recover. Keep in mind, if I talk about the economy recover, if you're reading about the economy recovering, that doesn't mean portfolios. The economic recovery is going to take a long time. We're going in with 10-20% unemployment here. That's going to take a long time to get recaptured. And of course, that means spending change, housing price changes, much longer term impacts as far as what we talk about economy. And then even when we talk about investment, there's the broad indexes like the S&P 500, the Dow Jones, the TSX. That's showing the full GDP, the full breakdown of all the industries in those particular indexes, where some industries are going to perform better. Even through this, we've seen tech kind of leading the pack, versus real estate, oil, airlines, bringing things down. So that doesn't mean portfolios won't recover for 1, 2, 3 years, which is some of the predictions as far as economic recovery goes. So keep that in mind. Portfolios can perform very differently, and that's one thing. The way that we manage money is risk first, which is why we de-risked early, because we did not want to go for the deep drop. And we often do that in our clients' portfolios, is to try to avoid more of the drop and maybe get less of the upside, but you actually end up with more money in the long run because you didn't fall as much, and it's also a much smoother ride to handle. So it really depends on your approach to investing. If you're fully invested all the time, you will see higher highs potentially, but lower lows. And always remember, if your portfolio falls 20% and goes up 20%, you're not at break even yet. So we always try to avoid that 20%, and then we don't have to get the full 20 to come back to new higher highs than the overall market performance. So long-winded answer to that question, but definitely if you'd like some more specific examples, reach out. So I looking at my time here. So that's pretty much it for my time. So as always, thank you, everyone. Do reach out if you have any questions. If you want to review anything particular of yours, give us a call, give us an email. If you're watching this on replay, Our contact information is down below, or you can go to mikeonmoney.com. We'll take you to our page, and we will get back to you as quickly as possible with any information we can give you. The other, oh yeah, sorry. I was trying to read something in my screen at the same time. My apologies. So the other thing to keep in mind, Friday we'll be coming out with our deep dive. As always, grab a watch of that. If you're a subscriber on YouTube, you can subscribe to our channel so you always get those announcements. And if you like them, like them. And lastly, before I let you go, send in any question, or sorry, anything you'd like to see more of as far as topic goes. We always appreciate that, and feedback on how you enjoy these presentations. If you'd like to see something different in them, any of that feedback just helps us make it better for you. So thank you, everyone. Have a great day. Enjoy your week. I think the sun's coming back out, and we'll talk to you again next week.